Hello folks, hope you are enjoying your weekend. This is the weekend edition for the ICT Mentorship, February 26th, 2021. And as the usual suspects, dollar index, euro, cable, and our lecture topic is going to be concern for equities. All right, so here's the economic calendar for the week to come. On Monday, London Open, 4:30 a.m., medium impact final manufacturing PMI for cable. 9:30 a.m., Canadian dollar, medium impact manufacturing PMI. 10 a.m., high impact dollar based ISM manufacturing PMI. ECB speaker, medium impact for euro at 11:10. At 10:30 p.m., Australian dollar high impact RBA rate statement and medium impact cash rate. Tuesday, New York Open, 8:30 a.m., medium impact Canadian dollar, GDP. 7:30 p.m., Australian dollar high impact GDP. Wednesday, New York Open, 8:15 a.m., medium impact dollar based non-farm employment change. 10 a.m., dollar medium impact ISM services PMI. 10:30 a.m., medium impact for dollar crude oil inventories. Watch that one for Canadian dollar. 11 a.m., GBP, medium impact speaker. And 3:15 p.m., high impact New Zealand speaker. Thursday, all day, OPEC meetings. 12:05 p.m., high impact dollar, Fed Chair Powell speaks. So that's going to be a concern, I'm sure. And then Friday, 8:30 a.m., high impact average hourly earnings, non-farm payroll change, unemployment rate. 10 a.m., medium impact Canadian dollar, IVPMI. All right, so basically we are back at it again with the non-farm payroll weekly protocol. That means all trades must be entered ahead of Wednesday's New York Open. We do not take any new trades, not that you would, but you wouldn't take any new trades if you were trading with live funds, let's say it that way. And for practicing, refrain from doing that and just do paper trades or observations. So the purest price action and the least manipulation tends to be in the first part of the week, Monday, Tuesday, and London session on Wednesday. After that, it tends to get a little manipulated, let's say it that way. All right, so we are going to go into this a little bit differently because the videos tend to grow a little bit longer as I do this, and there's going to be more details, obviously. So it's important that you have your charts dressed before you look at mine going forward. Okay, so that way we're not wasting time looking at a blank chart that transfers annotations later on just by me clicking. That's useless. So we're going to go right into it. We have this range in here, so what I'm highlighting. And if you ran your fib on that, you'll see that its equilibrium is here, which is 50%. So anything above that level is a premium. Anything below that is a discount. As we dropped lower, my concern was, and I brought this to your attention ahead of this being traded to, this rejection block, extending that through. Now I got a question from one of the students, and their question was, is this the real rejection block? Well, if you look at the data, you actually fall short of 1 pipette. So it doesn't, even though it looks like it goes there, it falls short of 1 pipette. And this is not what we're looking at. I'm looking at the market structure. Here it runs up, then it goes down. All of this is kind of muddy. It's all part of the same price swing from here down. So I would not look at that as a rejection block. This one here, clearly distinguished among all of the price swings. This one is the stop run below that low. So that rejection block is the pure rejection block by my definition. The low to high, it trades back down below equilibrium, and couple that with that rejection block. The blue shaded area is what would be deemed the optimal trade entry area. In other words, this is 62% retracement level, 79% retracement level, respectively. Okay, so this would be like the typical optimal trade entry that you learned about on my YouTube channel in the free lessons. We did not want to see it trade down below that rejection block and go back higher, because if it did, well, this is what we would expect. And it's interesting to see how it delivered like that, isn't it? It's almost like we know what we're talking about around here. So what's remaining on the upside? We have the short-term high here where there's buy-side liquidity, and to the left of that we have the bearish order block, which is the last up-close candle prior to this drop. So be mindful of this. Okay, worst case scenario, this is what's possible. Okay, we could just be hanging around in between this low and this high. As I mentioned, nothing has really happened that would be considered all that exciting for dollar. Now, if you're zoomed in on lower time frames, then this looks dynamic, but it's really not that big of a deal. But it's still tradable. It's reasons for us to look for shorts in foreign currencies. And if it does want to keep going higher, we have a buy-side liquidity pool here. And we have the mean threshold, which is the middle of this up-close candle. So that's a level that you'll learn about if you're new. But the rest of you all know what this is. That's the midpoint of that. That is not consequent encroachment. Consequent encroachment is coupled with the gap theory, okay, or imbalance. This is an order block. So whenever we look at the midpoint of that, it's mean threshold, just like it is with a breaker or a mitigation block. Then we have the high in here. And then go to the left of that, we have the volume imbalance. So should this thing get really animated, we could see 92.20 thereabouts and trade back up into this volume imbalance. But we'll see what we get. Hourly chart, dollar index, we have a market maker buy model. And if you don't know what this is, you will learn about it. But we have the original consolidation here. It breaks down, comes back, returns to the original consolidation. This is distribution. Sells off. Here's that optimal trade entry blue shaded area that I showed you on the daily chart. So that way we have a reference to the daily chart where we're trading in a deep discount. Okay, so we have a small little consolidation here where sell side liquidity is pulling. It means traders that want to see that as a buy, they protect that position with sell stops. That's what sell side liquidity is. Buy side is traders that are selling short that have their buy stop above that to protect their position, or buying on a breakout if they thought it was going to go higher. Much like traders here, they see this as an area that can sell short and be a breakout artist there. Sometimes they get a little bit of a piece of that move and they think they won the lottery. But we outlined last week that Thursday could potentially see a opposite end of the weekly range, and it came in like gangbusters. So that rejection block that I showed you on the daily chart, that's what's being shown here. It trades down through that on Thursday and then sends it higher. In this high and in this high here, if you've understood and studied my market maker buy models, it is covered in the mentorship. So don't send me emails concerning this, because it's going to probably go over your head if you're new. Don't be afraid. Don't be intimidated. Just write down whatever questions you have pertaining to this, because there's detailed lessons in later months. Okay. But for those that are familiar with the market maker buy model, notice that inside this high, it's not just the high and the high that gives us resistance, and resistance once traded through its support. That's not what we're looking for. Okay, we're looking for it to trade down inside of this high, and this is what we're looking for, the imbalance. So this reference point gives us where there was old distribution on the right side of the curve, which is everything to the left of all this decline. When it turns, it starts to go higher. This is the buy side of the curve of a market maker buy model. To the left of the turning point is always considered the sell side of the curve. The curve is the lowest low and draw it straight up. Okay, so everything to the left is selling, going short. And in smart money reversal, well, you now have seen what smart money would look for to get that reversal. Okay, look at the previous teachings this week. The market rallies. Your eye goes here. And what you want to do is you want to take that up close candle, extend it in time. And inside that range, which is not being shown here because otherwise it would clear up the chart, you're going to look for an imbalance or a short-term stop run on a short-term low. One of the two. Here, you have a fair value gap. So the market trades down into that. Now, look at this over there. See that? See how they couple together like that? It's not support and resistance. It's not supply and demand. It's institutional order flow. And what was done over here on the sell side of the curve, which is selling, is now going to be buying. Distribution becomes accumulation here. Distribution here becomes accumulation here. So selling short here by the algorithm will now become buying by the algorithm over here inside the fair value gap. This area distribution, extend it out in time, there's an imbalance, it trades down to the bullish order block. I know some of you are going crazy right now. You're like, wow, this is amazing. Yeah, it is. What's even more amazing is how I learned it. It's crazy, isn't it? So bullish order block hits it, fills the gap, and then rallies. So we have buy side liquidity resting above the original consolidation, and then we have that old daily bearish order block. As I mentioned, we might see it trade up into. So this is what a market maker buy model looks like and how to frame up these turning points and what you would look for setups. We'll talk a lot more about that in the coming month. All right, so the dollar index, 15-minute time frame, we had buy side liquidity above this old high here, and you can see we outlined that Thursday weekly low, the potential for it to form, when it should form, where it should form, at what price, and with what context that would be the reason for a potential turning point. And it capped the weekly range there. We had a gap opening here on dollar. It trades down, clears short-term lows here, and then trades higher. Even when there's a gap like this, okay, what you want to do is extend the closing price to the opening price here in your mind, like there's a candle there. If it trades down through this gap and below the short-term low, just imagine that as having a candle there that's completing that, and it would look just like a normal breaker. Okay, for instance, like this one here, we have a low, high, and a lower low. That's a breaker because their sell side liquidity here is taken and then it runs. So you extend this in time over here, and that would potentially set up this as a breaker. Well, this is a breaker as well because we have a low, the high it opens at, even with the gap, it trades down over that. So this gap gets traded over, it takes the liquidity and then runs. Once it goes above the gap, it trades back down into it, finds support in the gap here, runs again, trades back down again, creates another breaker, but then it also trades back into this gap as well. I did lessons on this weekly gap opening, and the same premise behind that weekly gap opening you use with all real gaps like this. This is a real gap where it's simply no trading at all because the dollar index is opening up a new session at this candle. So we have a breaker here, it rallies. The buy side liquidity here gets taken just on a shallow basis and then runs down, takes sell stops here, then rallies hard. Institutional order flow here, we have a buy side imbalance, sell side inefficiency. Right at that candle's low or below it, you can be a buyer in here. Then it rallies. And then this is February 17th's high is what we're looking at here. It could potentially reach for that buy side liquidity. All right, on the 5-minute chart, this is the daily log entry portion. And again, I mentioned the dollar index the last time I did it, so I'm just going to keep that theme going. Long and open kill zone, we have the Judas swing here. Now, this is after Thursday's turnaround. Okay, so we had Thursday's weekly low form. Friday, we can anticipate higher prices on the dollar. Sell side liquidity pool here, real easy relative equal lows. So we're not interested in chasing it. We want to see, does it come back down and take that? It does, right in the middle of long and open kill zone. And it's the rejection block here. Trades through it, so we have a couple things there, and then it rallies. And then we have this low to this high. Now, why this one? Why am I anchoring this line here to show the optimal trend entry there and not down there? Well, you could use it down there, but I want you to look at the difference between this low and how price moves away, and then we have this low and then how price moves away here. Is there any difference between how the price moves from this low up to here versus where this low moves up? Is there any distinctions that you could make between the delivery of price in this area and this? This is much more dynamic and energetic. Okay, it's much more animated. So when you see that type of move here, you always want to try to look for these anchor points, which are fibs, if you're looking for optimal trade entries. because that will many times anchor you with what the algorithm is going to remember. This low, while it may be a level that would line up with optimal trade entry, might not always do it. In here, what you're really looking for is the market to go to a discount. So it's not like the algorithm is looking for the standard 3/4 pullback on a Fibonacci. Okay, what it's doing is it's moving from this low to this high and then splitting that in half. That is your equilibrium, and we trade below it here into a fair value gap, into a breaker, because we have a low, high, a lower low. Take that up close candle here, right there, extend that out in time, hits the top of that, and it's overlapping with optimal trade entry at the same time of the day that you would expect to set up the form. New York open. What's the bias? Well, Thursday created the low of the week. We've already seen London, so what should happen in New York? Continuation of London. Market continues to consolidate a little bit, and then we have an energetic run in London close. London close is always typically used to get in sync with the higher time frame. What's the higher time frame likely to do? Well, if we made the weekly low, it's probably going to trade higher, and then you have this big energetic run here in London close. All right, so I want to talk a little bit about a specific level in the midweek review I discussed, and I mentioned I would show it to you in a weekend commentary. Okay, so I have the 5-minute chart trained in on the 22nd of February 2021. Right in here is where we're focusing, and it's this down close candle, which is a breaker. We have a high, a low, and a higher high. So if we take that and draw annotations on it, we're framing that. And you'll remember these levels here on the midweek review. If you don't know what I'm referring to, it's around the 4-minute mark to 4 minutes and 15 seconds on Wednesday's video, the 24th of February, 2021. This high here has buy side liquidity or buy stops above it. And when we ran from here up, they've taken out those buy stops. So they rated that. So anyone that wanted to sell short here, their stops are there. So they want to be a buyer there. Sure, the algorithm will run up there and give it to them. They can be a buyer and get stopped out with a loss. The algorithm provides the opportunity for smart money to sell short to those buy stops and take their position over, which is the nature of the breaker. That's why I named it the breaker. It's breaking these initial shorts and breaking their spirits, their hearts, and their accounts. And you get it. I'm being mean-spirited when I made that name because I was falling victim to this a lot as a beginning trader. So this pattern is very special to me, and this accumulation of shorts, once it starts to break down, we have a little bit of retracement here and it breaks down again. But look closely inside of that breaker. Okay, this is a 5-minute chart. Look closely. See that fair value gap right there? That's the fair value gap I mentioned that I would counsel you to go back and look in the 5-minute chart. Inside that range, what range? That range. And you'll see that fair value gap. Okay. And once you have that, you can highlight that and then extend it out in the future. And this is going to look very familiar to what I was showing you, except for that shaded area, obviously. And this is the 15-minute time frame, and this is what it looked like in your chart. And look how beautiful that delivery is there. So it's reaching up into that fair value gap on the 5-minute chart inside of this area. I had a student ask me, what is significant about this area in here? And I just outlined it. Okay, I just gave you the real details to it, the nuts and bolts. Also, at the 4-minute and 15-second mark, or 4-minute to 4-minute and 15-second, you see me refer to these green lines here, and I take your attention back to this fair value gap there. So again, go to Wednesday, February 24th, 21's video, scrub the video over to 4 minutes or right before 4 minutes and let it play for about 20 to 30 seconds. And you'll see me guide you back through and show you a zoomed in area of this. It's not necessary that I show you here. I'm showing you how to find it in that video. But why am I using this gap? I got a question about that. What's so significant about that? Because yes, it was important here. It makes sense there. But then it trades down through here and it comes back up. Yes, it makes sense there, but shouldn't it be done with? No. Remember, fair value gaps, we want to extend them. But what I'm showing you here is the significance of why I kept that and didn't mention it in the video. See this big run up? All this here is building in a premium. If we eventually take out this low, as we do here, this imbalance, the algorithm will remember that. See, you all think it's the bottom end of that because that's support. Look, it took off, right? So if we go below that, that's going to be resistance. We have support, and then here we have a little area where it acts as what you would expect, resistance. But does it really deliver all that much? Not really. And then what's it do? It hammers it right back up. And it starts working this level again. Notice how many times it works inside here. Here. Overshoots it a little bit in here. That's where the liquidity is. Then it goes back into here. Consequent encroachment. The low. Trades through it. Comes back in. And I mentioned this day. I said, look how it hits that in here. And then sells off. And then we accumulate around the consequent encroachment here. And again as well there. And sends it higher. What's important to me is this key low, because we've had premium built in. If we take that low out, if there ever is a gap here, I'm going to use that going forward because the algorithm is going to think about that low and where the imbalance resides, and it'll use those as key levels. So it's not support and resistance, it's not supply and demand, it's the key low that formed prior to all this building up of a premium, and then the market structure breaks that low there. It doesn't mean the market structure is bearish and keeps on going because of that, and that's the focus here. This is all really an advanced lesson that I can't build more on because there's other lessons I'll have that help you understand this one. So just remember that there's something to these things that I'll talk more about, but it's really in charter level. All right, Eurodollar daily chart. Here's the fair value gap I mentioned that we would probably see it trade up into. Man, I'm getting real lucky around here, aren't we? So we had the fair value gap almost completely closed in. It would have been really fascinating to see it trade just to it and then sell out like that. That would have been awesome. But it's okay. Just enough to, I guess, win the hearts and minds of my students that just came in. If not, stick around. I got more magic tricks for you. But we have the bullish order block in here. We outlined that, trade down into that. We want to see if it wants to run higher. We had liquidity here, this old liquidity here I mentioned, and then if it gets above this candle, I said that we would go into this fair value gap, and we did that. So that was really nice to see that happen, and look at the reaction there. Boom, off of Thursday's weekly high forming on Thursday at the time of the day with the price level I pointed to, and I want you to think about the importance of seeing it, witnessing it, watching how it performs based on the things I outlined. And I got a lot of you on the last 2 days watching what I've outlined in the video, and then you all watching it perform in price. It's it's very pleasing for me to see the results of your paying attention, obviously, and then seeing it happen. And then it's like, it's amazing, isn't it? It really is amazing. When you understand what you're looking for, this same thing happens on a 1 minute chart, and you'll be able to see where it should turn and have these reactions like this. And this, I did it with a daily chart. So if you're a long-term position trader in mind, that's what you want to do, or you just have to do it initially like that because your business, your job, or whatever prevents you from doing intraday trading or short-term trading, you can see that this stuff still works on daily charts. Okay, so this imbalance right in here, this buy side imbalance, sell side inefficiency. Now notice that I'm calling it that and not a fair value gap now, because there's a fair value gap here in contrast to this range. This is larger than this smaller little range here. So this is a fair value gap. This is a buy side imbalance, sell side inefficiency. It's the same thing. It's just I'm categorizing it with the smaller range with a fair value gap. This is going to be the responsiveness. This is the one where it can touch in a little bit of that range and then run, or go half of it, consequent encroachment, or completely close it in. Either way, the real importance is knowing where they are and extending them in time, because they're going to be traded back to like real support resistance would be expected. We have sell side liquidity pool here and another one here, and let's go to the hourly chart. So here's Thursday, day of the week. The market trades up into there off of a fair value gap. It trades in the consequent encroachment and pumps up into Thursday. And look what we have here. We have one big range here, buy side imbalance, sell side inefficiency, and then a sell side imbalance, buy side inefficiency. BISI, SIBI. Now I mentioned this the other day with that little annotation on the chart, BPR, balanced price range. We have one candle deliver and another candle deliver. So that is going to offer stiff resistance. Look what it does. It trades into the range a little bit, but look what it does after that. No, I don't need to go up here anymore. You see that? Anybody else would see this as, oh, it's going to come down and fill that, and I'm going to be a buyer. If they don't have the logic I outlined ahead of time on Thursday, how it could potentially make that weekly range high, then yeah, you would fall victim if you didn't know that. But you know better now. So this isn't likely to fill and rally. It's waiting to see if it runs through it. So you have to have context. What's occurring here? This decline is framed on something, and that's what I outlined all this week and the previous weeks, talking about the weekly range, how it forms, what you should be looking for, and some of the characteristics that make the weekly high and low form when it does. The balanced price range, it trades up into it there and has a little bit of a muddy price action, just back and forth. And then we have a nice little fair value gap here with a bearish order block. It trades up into it. Look at the bodies of the candles filling in right to the body of that up close candle. You see that? So the gap is filled. We overshoot it with the wick, but it does not overtake the bearish order block. See that? That's important. So if you were taking a short, let's say you're saying you're going to be a short on euro, and you see this bearish order block, and you're trying to sell it here, would your stop loss be above this one or this one? You're going to frame it on here. Now this is going to, again, if you hadn't been paying attention over the last couple of weeks since you first came in, and I talk like that, it's real uncomfortable. It's like, oh, you have the benefit of hindsight, and you're telling me what would obviously work. Think about what I've been showing you, okay? Now, I haven't had anybody send me any emails from the new group saying, because I've had groups in the past where I've talked about things because they haven't watched older videos where I'm showing it and taught the principles. And then when I took the liberty of saying something that I felt that I was in a position where I've earned the right to say so, I had people in the back, older groups, that quit, but before they did, they had a real hard criticism saying, you're talking about something in hindsight. You didn't do this. You didn't do that. I'm telling you the logic that I would do, and you'll actually see me doing these things and more things that you've watched happen this week. But the logic is this move here. Remember, this is all muddy price action. It's back and forth. So if you're trying to be real precise in this area here, this order block, yeah, if you put your stop loss just above that by a couple pips, you may have been spared, but maybe not. So you have to go back to what really framed the move lower. It's not just this, it's this off the balanced price range. So this up close candle, your stop would have to be above that. So your risk would be from here to there. Okay. So bearish order block, it sells off again. And then we have another scenario, just like this one in here. Bearish order block trades back up in. We have it here as well. Bearish order block, it sells off. We have a little fair value gap there. So it trades right back up into the order block there. Now in this instance, you can use the actual order block because we've moved away. Order flow has indicated that yes, we're bearish here, and we got an opportunity for it to sell off here. Does it? Yes. So now we have an up close candle. It should not trade through that up close candle. This up close candle is your bearish order block. So if you sell short at the bottom end of that, you can put your stop loss just above that. You don't need to go back to this or this. You can extend that in time, and it would also, if it's going to reach up into this order block, it would probably just touch this level here if you extend it out in time, if it would have done it. And that's how you use the fair value gaps, also extending them in the time. This is that old buy side imbalance, sell side inefficiency on the daily chart, and the levels here. This is the premium level. This is the discount level. We still have a residing fair value gap right here. It hasn't gone into that yet, but it did trade down to the discount level of that buy side imbalance, sell side inefficiency on the daily chart for euro. In the 15-minute time frame, again, here's that fair value gap consequent encroachment, leads up into that turning point on Thursday, and then it tanks. Here's the balanced price range levels that was defined on the hourly chart used on that 15-minute time frame. And we have an optimal trade entry here, fair value gap there, sells off in here, order block trades lower, and you can really see that if you were trying to sell it in here, where your stop needs to be above that. Order block sells off, small little fair value gap in here, trade overshoots it a little bit, I'll give you that, but your stop would have to be above here, not above relative equal highs. You see that? You never want to sell short here with the fair value gap in this area be like it is, because it's going to probably reach up in there. If you look at if you have a live account, not because I want you to trade with a live account yet, but if you do have a live account or access to live feed, these relative equal highs on your broker's feed, you can probably see this actually going above that, because they're going to try to get the in-house liquidity on that live account server. Price breaks down, fair value gap again, bullish order block, optimal trade entry, and sells off and trades to the bottom end of that daily buy side imbalance, sell side inefficiency. Daily log entry for Eurodollar 5-minute chart. You can see the London Open kill zone here, and just real flat, just not a real easy day, I'll give you that. I would have expected that to trade above that and then sell off, but it didn't do that. Sold off, bearish order block in here, small little fair value gap, it fills that. Distribution comes back in, another level of distribution. This low comes in at 120.92 and 7 pipettes and starts to rally. It rallies through New York Open and gets into London close right in here. Optimal trade entry from high to low, trades up into that, takes some buy side liquidity out, and the bearish order block right there, all through this fair value gap and the order block coupled. Time of day, London close. Why London close? Why not New York? Because it's in sync with the higher time frame. The higher time frame has now become bearish. So watch your London close kill zone, and you can see setups like this to get in sync with the higher time frame that has potentially changed. So back to this old low, 120.92 and 7 pipettes. Sell side liquidity resides below that. 10 pips below it, 20 pips below it, 30 pips below it. 120.62 and 7. That's 30 pips. And it's just a little bit lower than that. Okay, so if you look at that, I think it's maybe 3 pipettes. It went lower, but it's still basically 30 pips. Okay, and you're always going to have that small little deviation because of the broker's feed. They're allowed to make that spread wider or less wide around the highs and the lows. All right, cable. We are looking at the daily chart, and we have a fair value gap in here with the bullish order block. We traded down into that. It'll be interesting to see if we get some reaction into the first part of the week coming up. We have a small little volume imbalance in here. Notice the gap between the closing price on this candle right here and the opening price on this candle here. So there's a small little volume imbalance there. We could bounce up in there, touch into that, maybe trade at 140.20, 140.25-ish. And then if it's bearish and dollar continues to rally higher, and then it could make an attempt to go for this liquidity in here and ultimately try to trade back down into here. And that's assuming a whole lot that I don't know, especially with non-farm payroll week ahead. This is the bearish order block on the daily chart going back, as I mentioned in previous discussions, and the fair value gap, consequent encroachment, and the low of the fair value gap as I outlined on previous videos this week. All right, hourly chart. You can see the daily bearish order block it trades up into here. And again, avoiding trying to pick tops. I know it feels a little deflating to see a move like this, but grow accustomed to letting these types of moves happen. It's better for you not to get hurt than to capture moves like this. You can anticipate the likelihood of it happening, but you're going to miss moves, folks. I mean, you really are going to miss them. And missing some moves isn't the end of your career, and it doesn't make you a weaker trader. You need to balance your pursuits of precision and accuracy with also safety and longevity and continuity. You don't want a roller coaster ride with your equity curve. You want it to be sustained, upsloping, but you don't want to be jagged, okay? And you don't want to take big risks, and you don't want to be doing gambles. And gambles are trying to pick tops in the marketplace. We have tools here to help warn potentially of those things, but it doesn't necessarily mean it's going to happen. And I want you to remember that when I talk about the equities portion at the end of this video, because I'm going to highlight something that I see that is a warning sign. It doesn't mean that I'm going to see the market perform like I'm thinking it might, right on Monday. Okay, it could, but I'm just giving you the warning signs that I see. But on Thursday, we had a lower high than what we saw here. This is a big blow-off parabolic move. Even though it could have continued, we have to err on the side that it's likely to see a higher high form. It doesn't do it here. So it fails here, and it works those imbalance levels that I gave you. And it breaks down, bearish order block in here, with optimal trade entry there. And I know some of you are thinking, how is that optimal trade entry? If you go down into your lower time frame charts, you'll see that. But it trades into it here, small little fair value gap as well, and sells off fair value gap there and optimal trade entry. But then it really goes into some really muddy waters on the lower time frames, as we'll see. We have a buy side imbalance, sell side inefficiency that's just dipped its toe into. And we'll see if it wants to go back up into any of this imbalance here, or just stay heavy and go below the sell side liquidity pool here. All right, 15-minute time frame on British pound, and nothing really all that exciting that wasn't already shown on the hourly chart. Institutional order flow entry drill here with this gap, looking at the high here. If it goes to that level or a little bit higher, you can sell short. And then here's the optimal trade entry there. And we have the imbalance on that 60-minute chart that you can see it trades back up into here. And right away you can see it's just not any bit of clarity at all. So when you see price action like this, it's better to say, you know what, I'll watch this from the safety of the sidelines and see what happens, because this right here is a market that does not know what it wants to do. So it's better to stay out of the way. It could create a gap higher opening with this type of price action, gap higher opening, and then ram right up into all this here and just upset anyone that's already short. Because again, a lot of people want to sell short and try to be George Soros part 2. All right, so daily log entry for British pound 5-minute chart, and you can see it's basically a heart attack. So London open kill zone, nothing really to speak of except for the imbalance it trades up into here, and then works the sell side liquidity here, and then back and forth choppiness. It's really no rhyme or reason, and I'm not going to try to explain anything in here because there's nothing in here that I would find of any importance or salient to the discussion about high probability trading. This is just, whenever you see a market start doing this, stop trading, turn your computer off, and walk away. All right, so with that, we're going to go over to the teaching portion and wrap this video up. All right, so this is going to be a lesson that's probably going to be a little confusing for the new folks, and probably for the folks that haven't got that far into the mentorship, where I've taught the day trading and bond trading and short-term trading and stuff, and index trading. I include this here because it's something that I'm paying attention to. So if it happens, then you'll know why I felt the way I did. If it doesn't, you'll also know why it isn't important for you to try to pick tops and bottoms. So it's not one of those things where here's plan A and I'm right if it does this, or plan B and I'm right if it does that, and let me come back and flex and act like I know it all. This is one of those things that you're going to learn that are warning signs. But I'm going to show you something about the bond market and discuss the relationship to the S&P market here. Some of the students that came in 2016 under the idea that I'm teaching only Forex discovered that obviously I teach how to trade all markets. And one of the markets like this, the S&P 500 and the bond market, they were my original pet markets. Like you all see me talk about euro dollar and pound dollar as a Forex trader. Before I became a Forex trader, my favorite markets were these two markets here, the bond market and the E-mini S&P. So I'm going to talk a little bit about, and I'm not going to do too much talking, so it's probably going to be about 15 minutes remaining in this video, and then we're going to close it because there's so many things I could talk about here, but because you haven't got that far yet, and I haven't gone back to index trading yet for the charter members, to fill in all the details. I'm just showing you something that's got my attention, okay? All right, so if we look at just this chart here, okay, let me take this back to a single chart, and we're going to look at this relationship in here. In October, November, in this little area here, I'm going to show you what had happened and why I was saying that the market was going to perform as it did. So right in here, in this general area here, this is where it starts to drop. Before it does this decline, prior to that, if you compare what the bond markets were doing in relationship to one another, okay, and I'm going to show you one at a time. Okay, so we have this market here, which is the 5-year Treasury note futures contract. It's making higher highs here. We don't care about this high. I want you to just look at this here. Now I'm going to hide that and show you the 10-year. This is a 10-year note. See that? And then by comparing that, you can see right away that this is diverging from the 10-year. So the 10 years failing to make the higher high that the 5-year has made a higher high. So right away we have a divergence. Something's going on in the bond market, signaling something, and I'll tell you what that is in a moment. You could probably see, obviously, with the benefit of hindsight, but you'll also learn this, and this is something that I teach, and this is what I used to be a bond trader back in the 90s, and I was very good at picking turning points when I was using this. And if you go into looking at the 30-year ZB, and we'll take the 5-year off, you can see that we made higher high in the 30-year where we had the lower high in the 10-year. You see that? Let me see if I can show it a little bit better. It doesn't look like it's going to show me a way that, no, it's not going to do it. So if I take off that one, you can see it goes higher, lower. You're focusing between these two lines. Okay, that's where your attention is. Okay. Higher, lower, and with this one back on, the 5-year is screaming higher. So with all three of them, it's hard to see it like that. So that's why you have to compare and contrast as you go through individual ones. And you can see the symbols here you would put in to make this chart. This is the 5-year symbol, the 10-year, and the 30-year. An easy way for you to remember it is the 5-year has the F after the Z. The 10-year has the N for the word 10, T-E-N. That's how I remember it. And then the B is just the big bond. Okay, 30-year. That's how I remember it. And we do not do anything with the ultra bond. Okay, so don't worry about that one. These are the only three you need to worry about. But compare and contrast them. That divergence is indicating that there is a triad divergence there. Okay, interest rate divergence, and it's creating smart money signatures that say that there's probably going to be a turning point occurring. And when is that occurring? In the fall of last year. So that means if this is diverging like that, it indicates that there's likely that the bond market's going to decline. Now, if the bond market's declining, when you see this futures contract, because that's what this is, the futures market, the price on the contract that's declining is actually interest rates increasing. And when that happens, that is problematic for stock market over time. It doesn't like to see that. And then what will happen is the bond market will start to correct. And then as it's doing that, okay, it starts to set up another relationship with the S&P market, which we'll go into that discussion now. So here is what's occurring from around end of October and November. We can see that the bond markets were declining. Okay, so if we take our attention to just the big bond, okay, 30-year, it's declined from November down. So if this is declining, interest rates are increasing. But for a period of time, there's usually this tug of war between the investment dollar for bonds or stocks. There's always this competition between these two markets. And the way you want to look for buys and sell signals, if you're an S&P trader or a bond trader, is you want to look at the relationship between its opponent, the tug of war opponent for that dollar that would be invested in either or bonds or equities. So the market's bearish for bonds. So if this is declining, that sets the stage for a bullish market for stocks. So the stock market goes higher. So if the market's going higher, when should it start? Well, it's declining in November, then it should see a stock market rally in November as well. Historically, like as you'll learn, that this is a really sweet spot to be a buyer for stocks. And the market has done very nicely this year. Surprisingly, with all the stuff that's been going on with the election and such. But here's my concern. If we go into this little low right here, we've had a real nice decline, and now everybody wants to be on board. When that happens, it typically creates a low. And I want to take you into now, we'll go into a 4-hour chart first. That's probably all we need now. You can see the 5-year here. See this low? It made a lower low. You see that? Did the 10-year make that lower low? No. Did the 30-year make that lower low? No. So it's diverging opposite to what I showed you back in October and November. So that big divergence back here, it set up that move here. Now, I'm not saying this is the low of bonds. I'm just saying that this might be indicative of a tradable rally in bonds. And that would set the stage for this relative equal lows here on S&P to be traded down into. If the bond market continues to go lower, then we could probably see, equities continue to do what they've been doing, which is, in my mind, ridiculous. Like this for the stock market to be where it's at, there's only a handful of companies that are making money. I mean, that's the reality and the truth of it all. All this here is just speculative fluff. It's just fake. It's all fake priced in. And this right here, decline, is the lack of interest in buying the bond market because the money's pouring into stocks. But now we have this warning sign here that this may be changing, at least for the short term. And that would allow for this area in here to be traded to on the S&P. Or it could get really animated and excited and trade below this low here. So we're going to see. But if we get some real terrible news for equities, this is just, to me, that's where all the money is for large funds. They're not up here with their stop. They're here. And it's a lot, but does it happen really quick? It depends on what happens. We just had Biden come out and attack Syria, and while it was, I guess, considered a measured response to whatever, we're right back into that Syrian and Iranian, conflict that they want, because Syria and Iran are two countries that we have been for years trying to find a way to get in there and start messing around with them, and we've not been successful up until now. We've done a little bit, but a lot of nations in the Middle East have fallen victims to the United States form of democracy. Okay. And I know this might sound like I'm not American, or I'm looking at supporting terrorist nations, and that's not what I'm saying here. You just need to know your history. Okay. And it's well documented that they had a hit list on what they wanted to do with certain countries around the world. And Syria and Iran are on that list still. And here we are, and The bottom line is this is going to result in a war. And that war, if it does come, is going to affect this market over here, which is going to affect this market over here. Where we are right now is unjustified in equities. And that's going to be seen with this market over here. It's already showing you that the market's having a higher interest rate. Like interest rates are going up. So if interest rates are going up, what does that mean for the dollar? Well, it's attractive. So to eventually get those higher interest rates that the market is offering here, they'll buy those bonds because now they're offering at a higher rate of return, but they have to buy them with US dollars, and the US dollar has rallied. So all three of these markets in certain economic climates work out a certain way. In inflationary times, it does some things, and in deflationary times, it does others. And in other times, like where we've had all this COVID stuff, nobody knows what it's going to do. Me included. I'm raising my hand, waving it to you. Okay, I don't know, and I didn't know, and I was very honest with everyone all throughout the year of 2020. That was a learning experience for me, and I was very surprised to see many of the things that I've been teaching you still hold up in those markets. But I was personally very cautious throughout the year. But that's my concern. I'm going to keep it real short to that. You know, I'm watching this area here. If we see an advancement on selling, watch this area here, and then we can potentially work out a run into this level here as well. If we get terribly animated on the downside, then we could look for something over here. Okay, but that's on my radar right now for equities, and it'll be interesting to see what we get. Obviously, if we run back above this high here, then it puts it on the back burner, and I'm not really concerned about it for a while then. But as long as we're below this high, my attention for equities is right in here. Okay. And that is going to be it. I guess I'll talk to you on Monday with our daily log entry and teaching, because we're going to have a lot of teachings going forward. Until I talk to you then, enjoy the rest of your weekend. Be safe.